In this lecture, I'll show you how to place some orders. I'll show you how to place some pendings, include some stop losses, and some take profits. Now, we all understand the concept of buying low and selling high. But did you know you can also sell high and buy low? This concept relates to what's called short selling, or also known as taking on short positions or going short. To short sell, it's very easy. All you need to do is select a pair. So I'll just go ahead and select USD Yen, and I'll just open up the one-click trading panel, and I'll just hit sell. Now, as this pair continues to fall, I'll make a profit. So I'll just go ahead and open up my trading terminal so you can see that right now, because this pair is continuing to climb, I'm starting to lose on the trade. But what I can do is click on this green line here and just drag it towards the downside, and I'll just let go of my mouse. And what I just did there was placed a take profit, and that's what the TP represents. So if I hover over this red dotted line, you'll see if price falls down to this level, I'll make a profit of $46.59. So essentially in trading, it doesn't matter whether the market's going up or down, as long as I'm correct in the direction that I'm trading. Now, because I am in a short selling position, and if this pair continues to climb, I'll be sitting in a bigger loss. So what I would like to do is go ahead and put in a stop loss. So in order to do that, all you need to do is click on this green dotted line and just drag it up and let go of the mouse. There we go. So if price hits this level here, I'll lose $70, $70.24 US. The great thing about adding in a stop loss or a take profit is it allows me not to watch the charts. I can simply set the stop loss and the take profit and walk away. And if price continues to rise and hits one of either the take profit or the stop loss, the software will automatically close the position. Even if the software is turned off, it will still close the position. Now that's one way of short selling. So what I'll do here is I'll just go ahead and close that. And the other way you can go about placing a trade is simply by clicking on the new order button at the top, and then you can either hit buy or sell. You can do an instant market execution, or you can also do a pending. Now when it comes to pending orders, there are 4 different types of pendings. And I made some diagrams to help illustrate what each of them represent and how you can best use each of them. So let's go ahead and take a look at these illustrations. So we have sell stops and buy stops. And we also have buy limits and sell limits. So let's start by taking a look at sell stops and buy stops. So a sell stop is when the market is heading in a bearish trend, or the market is heading downwards, and you're looking to sell into the trend. So you're expecting momentum to pick up, and if it hits this level here, you want to sell into the trend. So that's why you would place a sell stop. A buy stop is just the opposite of a sell stop on the upside. So if price is rising, or if momentum's starting to pick up, or if there's any sort of breakout happen, then you want to place a buy stop, expecting that the price will continue in an upward trend. Now, a buy limit and a sell limit is when you're expecting a bounce. Okay, so if price is selling off and it's coming down to a significant level where you're expecting traders to start locking in some profits and you're expecting a bounce, that's where you would anticipate placing a buy limit. And a sell limit is just the opposite of a buy limit. So if price is rising to a significant high, so say for example the S&P is hitting an all-time high, you might consider putting in a sell limit at that particular point. Now let me just go ahead and give you some practical examples of sell stops, buy limits, and sell limits. So let's see. Let's say we are expecting price to continue this downward trend. And so if price is able to make a lower low than this wick, we want to get into a sell stop. So the sell stop is we're anticipating price to continue much lower if it breaks below this wick. That's just an example. So what we will do is go ahead and hit new order, and I'll go ahead and select pending order, and this will be a sell stop, and the price will be 113.78. I'll go ahead and hit place. Actually, I'll just move this up a little bit. There we go. So now if price hits this level, then we will get into a sell position targeting further lows to the downside. So as it continues to weaken, we will be making a profit. That is a sell stop. Now, a sell limit would be if price is able to climb up to this declining level of resistance and we're expecting a bounce. That's where we would put in the sell stop. Sorry, the sell limit. Okay. So I'll just go ahead and delete that and just give you an example. So pending sell limit with this trade, and the price will be 113.88, and I'll just go ahead and hit place. Now you can always tell if you're putting in the correct pending, because say for example this is what you were anticipating and this is what your intentions were. Just go ahead and delete that. If I were to put in say a sell stop at that level, the system won't let me. So I'll just show you that example. So if I were to put in at 113.88, see, it won't let me put in that order at that level. It's because it needs to be a sell limit. Okay, and so now what I'll do is just place another trade here. This time I'll just put in an instant market execution, and you can also manually enter in your stop loss and your take profit here. But what I'll do is, so I'm just going to put in a new order here. Oh, sorry about that. Yeah, so there it goes. It went through, and so you can either drag the take profit down towards the downside, or the other way of doing this is just to click on the trade in the terminal and then just hit modify order, and then you can just manually enter in your take profit and stop loss. So take profit for this example will be 113.72 and stop loss will be 114. There we go. So we have stop loss above, take profit down below. Okay, so that sums up for this lecture. In the next lesson, I'll explain volume, lot sizes, margin, and leverage. I'll explain volume, lot sizes, margin, and leverage. Now, the first thing, you're probably noticing that I'm holding on to a few positions and they're in profit right now. And those are some trades that I made just before going to bed last night. So right now, we're looking at about a $603 gain. And in comparison to my account, that's pretty good because my account is only just over 5,000. So basically, I turned over about 10% while I was sleeping. And for most investors out there, if they make 10% in 12 months, they would be fairly happy with that. But I just made 10% in 12 hours. Now, a lot of you are probably wondering, how exactly did I do that? And I was able to do that with what's called leverage. Now, most brokers offer leverage. Some of them offer a lot more than others. Some of them offer 50 to 1. So 50 to 1 means for every dollar that I put in, they'll match it 50 times. And there are some brokers out there that will offer anywhere up to 1,000 to 1. Okay, I don't recommend going with those brokers. You don't need anything more than 200 to 1. And in fact, even 50 to 1 is great. Now, let me explain a little bit more what leverage is. When it comes to trading, you need to enter a volume, the lot sizes. So when you place a new order and the volume is 1.00, that's equivalent to $100,000. Now, we obviously don't have $100,000 to trade here, and that's where the leverage comes in. Okay, so if I wanted to trade $100,000 with leverage of 50 to 1, I would need $2,000 in my account. Now, if I had a leverage of 200 to 1 and I wanted to trade 100,000, all I would need is $500. And when you trade $100,000, every pip is worth 10 bucks. And when you trade $10,000, every pip is worth $1. Okay, so you guys can go ahead and pause the video and just remember this. Okay? And I'll just explain a little bit further what I mean by this. So here, when I enter 1.00 in the volume, that means I'm looking to trade $100,000. And so with $100,000, every one pip the pair moves, it's equal to $10. So for example, if we take a look at Aussie USD on a 1 hour, and you can see exactly where I entered the trade, where I entered, I sold 200,000, so I sold 2 standard lots. And I'll just go down to a 1 minute so you can see. So right now the price is 75,097. The last decimal place is sort of it's a fraction of a pip. Okay, or it's like a pipette. Okay. So the last decimal place is not a pip. So but when it goes from 0.7509 to 0.7510, and in this case it's 0.7511, that's equal to $20. With this trade here, because it's the volume is 2.00, every pip is equal to $20. So you can see on the profit here that right now the price is 0.7508, and once this moves, just watch the profits down below. So 0.7508. Okay, we're not getting much action this morning. I do apologize. There we go. So you guys can see that, you know, my profit went up quite a bit within. This is on a 1 minute chart. Okay, and I'm making profit as this pair continues to sell off. And that's because if I just go back to the 1 hour chart, I sold $200,000. Okay. Now, let me explain margin, and I'll just pull up the diagram again. So if I wanted to trade $100,000 with 200 to 1 leverage, I would need $500. And to see, with this account here that I'm trading, it is a 200 to 1 leverage account. So down below, you can see that I'm actually trading 400,000. So here's 100,000, another 100,000, and then a 200,000. So I'm trading 400,000. And my margin is just under 4,000. Sorry, so I'm actually trading 100 to 1. So the leverage on this account is 100 to 1. Because the margin is almost 4,000, And so each of these trades, so this one was about 100. This one required $1,000 because it's 100 to 1. Again, I'll pull up the diagram so you can see. So 50 to 1, I would need 2,000. On a 100 to 1, which is what my account is, I would only need 1,000. Okay, for a $100,000 position. Okay, so I can't keep trading as many $100,000 positions as I like, because this is my free margin here. This is the amount of margin that I have available to continue to play with. So I'll just give you an example here. If I wanted to, say I wanted to buy USD CAD, just go to new order, make sure USD CAD is selected in the symbols list, and so I want to trade 100,000, and just watch my free margin below. So I'll buy this, and you see it just required $1,000 from my account. So it didn't cost 1,000, it just placed that 1,000 in the margin category. So now my free margin is only 800 and so on. Now, depending on the broker, if your free margin starts to fall below 0, that's what's called margin call. And if you ever enter a margin call, the broker has the right to automatically close all of your positions without your permission. So that sums up for this lecture. If anyone is interested in viewing that leverage diagram, I've inserted it in the external resources section in the lecture. So now, just before I go, I'm just going to close these positions. Lock in some profit. And so now you see we have $5,577, and this account was just at 5,000 just within the last 16 hours ago. In this lecture, I'm going to explain the difference between bull and bear and long versus short. Okay, so I'm sure you guys have heard we're trading in a bull market or bear market before, or the trend is bullish or bearish. So I just want to clarify exactly what that means. So if we take a look at this pair Euro USD, this is on a 5-minute. I'll just switch it over to a daily. Actually, I'll switch over to 1 hour. So on the 1 hour, this is considered we are still trading within a bullish trend. So we are trading within an uptrend. That's essentially what bullish. So bullish trend is we're trading in an uptrend. A bearish trend is simply the opposite. So this would be considered sort of like we're trading within a bearish channel toward the downside, and that's basically it. So bull is essentially the market's going up, bear is the market is going down. Okay, and the difference between going long versus short, let me just explain that. So long doesn't mean I'm holding onto a long-term position. It doesn't mean like I'm investing for the long run. Long simply just means that I'm buying. So if I just press this buy button, I just went long on a position. So I'm holding a long position right now. That's all that means. So it's just a complex way of saying that I'm buying. And so let me just go ahead and close that trade out. Actually, I'll keep that open for the time being just to see what happens. And if I were to go short, let's see, pick USD yen. So I'm just going to go short this pair right now. I just sell it. So now I'm short selling USD yen. So I'm short USD yen and I'm long Euro USD. That sums up for this lecture. In the next lecture, I'll explain pips, spreads, and broker commissions. In this lecture, I'll explain the difference between trading the majors, minors, and exotics. Now, the majors are all made up of the US dollar on either the base side or on the quote side. Okay, so these are all of the major pairs. Minors do not contain the US dollar. Okay, so it's anything from Euro pound to CAD yen. And exotics are
currency pairs that contain a major and they're matched with the currency of an emerging or a strong but small economy from a global perspective, such as Hong Kong or Singapore and European countries outside of the Eurozone. For example, Euro, Turkish lira, or the US dollar versus the Hong Kong dollar. Now, the difference between trading majors, minors, and exotics, it's mostly the pip spread. So if we take a look at USD yen, the pip spread here is about 2 pips. Okay. And let's take a look at a minor. So CAD yen, the pip spread here is about 3 or 4 pips, give or take. And an exotic, like the Euro lira, the pip spread is, it's about 16 pips. Okay, so this is something that you guys have to pay attention to because there's a larger buy-in commission required to trade an exotic versus a major and a minor. Okay, so for example, if I were to trade USD yen, and just pay attention to the terminal down below. So if I bought this, the pip spread is 2 pips. So if I bought one standard lot, oops, sorry about that. Let me just do that again. So if I buy one standard lot, it costed me about 20 bucks. So I was negative $20 the moment I entered the trade. Now, if I were to trade the Euro lira, just pay attention to my terminal down below, just buy this, you see that costed me about $60. Okay, so it's a lot more expensive to trade an exotic versus a major or a minor. Okay, so that sums up for this lecture. In the next lecture, I'll explain the difference between trading gold versus oil.
In this lecture, I'll show you the main difference between trading stocks and trading Forex in terms of commissions from the broker side. Now, we already know when trading Forex, the commission comes from what's called a pip spread. And the pip spread is the difference between the bid, which is on the left side of your trade terminal where it shows the price. So in this case, the bid is 78.30 and the ask is the 78.33. And the 78.33, this is the raised price that the broker raised it to, basically so that they can make a commission off of every trade that you make. Okay, so we already know this because we've went over this in previous lectures. Now, with stocks, there isn't necessarily a pip spread, and instead most brokers would charge a flat rate of around $10. Some brokers might also include a small spread as well as the $10 buy-in. So that's something that you want to watch out for when deciding on a stockbroker. So I've been using CMC markets for the last several years now, and I would highly recommend using these guys if anyone's interested in going and trading stocks. I'm not going to go over too much detail how to use the trading platform in this lecture, but I will definitely create some videos later on in the future where I give you guys some tutorials how to use this CMC interface. So as you guys can see here, if I just take a look at this is a Royal Bank of Canada stock with the TSX. So there is actually a small spread here, and it's 1 cent. So if I were to purchase 100 units, there would be the 1 cent spread. So it's not pips in stocks, it's just the last, it's the cent. All stocks are probably a little bit different though. Let's take a look at Apple for a second. Okay, so if I were to buy Apple again, yes, so here it's a 1 cent spread, but then there's also the $10 buy-in. So I would highly recommend anyone that's getting that's interested in stock trading to take a look at CMC Markets. They have the online application, which is available for all desktop and mobile devices, and they also have the apps available on Android and iOS in the App Store. I've always recommended anyone that gets into trading not just to focus strictly on currency pairs. You should also diversify your trading assets with stocks. Sometimes with trading Forex, it's sort of a patience game where you have to wait for the right trade setup to come along and then finally execute a trade. So if you're the type that finds you might become a little bit impatient in times and you trade a little bit too early, then it's a good idea to start looking at some stocks to pass through some time. So then that way you're not so eager to execute a trade. I know it can be very exciting, especially on one day if you make a couple $1,000. It's very natural for anyone to want to do that again. But it's always very important that you maintain good discipline and are very patient when it comes to trading. So take a look at some stocks, create some trade setups on some stocks that you like, and once the market starts moving in that direction where you want it to, then you can then decide if you want to get into some sort of short, or if you want to get into a long position, or if you're just going to wait it out even further. So it all really depends. Okay, so CMC Markets, guys, is who I recommend for going with stock trading. Thanks for watching. In this lecture, I'll be showing you the different types of trading sessions that happen throughout the day. Now, there are 4 main trading sessions that go on. There's the New York, Tokyo, Sydney, and London. Okay, so the Forex market is open 24 hours for 5 days a week. It's closed on the weekends. And in Eastern Standard Time, the market closes Friday at 5 p.m. and it opens back up again on Sunday at 5 p.m. as well. Okay, so sometimes when we see gaps in currency pairs, usually that's only from a Sunday gap because the market was closed. Now, in stock trading, sometimes when you see gaps, it's sort of a significant clue as to what might happen with the particular stock. For example, if we gap upwards, that sometimes tends to mean that there's a lot more bullish momentum in the marketplace and we might expect some continuation to the upside, and vice versa. Gaps towards the downside with stocks, that might mean we might start to see some negative price action continue with the particular stock. But with currency pairs, that's not how it is. With currency pairs, whenever we see gaps, it's usually from a Sunday gap. So for example, this small little gap here, if you guys can see that, let me just zoom in a little bit. So this little gap here, okay, that was a Sunday gap. Okay, so let's just go back over and take a look at the different time sessions. So London goes from 3 a.m. until 11 a.m. Eastern Standard Time, and there's an overlap from London and New York. So New York starts around 8 a.m. and goes until about 4 p.m. And then there's the bank clearing hours, which are from 5 p.m. until 6 p.m. So this is an hour when you shouldn't be trading, because you'll notice the pip spread for a lot of currency pairs has widened out. So right now the spread here is about 2.5 pips. During the clearing hour from 5 to 6, you might see spreads widen out to as much as 10 pips. So if you are trading at that time, you don't want to just look at a certain pair, think there's a great opportunity, go in, hit new order, and then hit buy or sell at right away, because you want to pay attention to the sort of spread at that particular time. Okay, so that could be something that might set you back a little bit, especially for newcomers. Okay. The other thing with these Forex trading sessions is that there's different sort of types of personalities. And, you know, we have to understand this, the players that are in the marketplace in these sessions. So at times, you know, there might be major banks, major hedge funds, major firms, you know, retail traders. We really need to understand who's in the marketplace at that particular time as well. There's a lot of economic reports that come out throughout the day, and these reports could impact the market, you know, in a very significant way. So this economic calendar I just picked up from investing.com, and so it actually gives us some reports that are due out later on today. Actually, there's API weekly crude oil stocks coming out, and the two bulls basically represents the importance. So when there's two bulls, it means that it's medium volatility, and when there's one bull, it's low volatility. But then when we have three bulls, it's very high volatility. So for example, when we saw the UK construction PMI, that's high volatility, and that happened at 4:30 a.m. Eastern Standard Time. So at 4:30 a.m. Eastern Standard Time, we only had the London trading session open. So that report was still very volatile, but you can imagine when a report comes out when there's the overlap from London and New York, and there's a lot more traders and players in the marketplace, that the market could be very whippy. It could be very unpredictable. Some firms or you know, traders are looking at reports differently, and they could be executing heavy positions. So that's something that you want to pay attention to, is the time of day that you guys are trading. Get into some sort of consistent habit of when you are placing trades. I remember starting out, I didn't really have some sort of routine, and I would just basically trade whenever I felt like it. But it's important to get into a routine and keep a log of when you're trading, because there's, like I said, there's different sort of personalities in these trading sessions, and you really want to get to know the market as if it's sort of like a human being. Okay, so you know, it's a lot of market psychology here. Okay, so you have to really understand how these players are thinking, you know, to protect yourself. Okay, so that's it. Those are the Forex trading sessions. In the next session, I will go over some basic risk management to protect your account. Thank you.